If we crypto investors could have a top predicting crystal ball for Bitcoin, we would pay good money for it, obviously. It'd be worth its weight in, well, Bitcoin, gold, I don't know. But alas, there is no crystal ball, newsflash. And as the Wall Street saying goes, nobody rings a bell at the market top. There's no orderly exit. It's all chaos. Still, let's try to have some fun with some educated guesses. Let's draw some charts. Let's try to conclude with the average price prediction from some seasoned analysts. Okay. I know market prices are down right now. It's been a rough few weeks, but I'm still looking forward and up. So let's talk about a floodgate for institutions. Let's start with why I'm pretty confident that the bull market will continue and the price will go much higher than it currently is. A big reason is the US Bitcoin spot ETFs and soon to be launched, of course, Ethereum spot ETFs. Each market cycle's pump seems to be preceded by the launch of some kind of new floodgate, some new liquidity inflow, some new way for money to enter into the crypto space. So here's the Bitcoin chart with some historical floodgate launches. So until around 2012, when user-friendly exchanges such as Coinbase launched, it was pretty damn hard for the average person to try to buy Bitcoins. Literally like sold on eBay and stuff back in the days, let alone institutions who had zero interest in it back then. It was really hard to get your hands on BTC. Then in 2013, the Grayscale Bitcoin Trust launched. So accredited investors finally gained a way to get exposed to the BTC price, although they were stuck in that for a decade, which is pretty crazy. It was a crappy product. Still is. Lousy floodgate. Still better than nothing, though. The next big floodgate came in 2020 when apps such as Cash App and Robinhood and PayPal all allowed users to buy Bitcoin. Now, as mentioned, the most recent floodgate and obviously a huge one, a once in a market liquidity event, is the launch of the spot Bitcoin ETFs in the USA with the push of the button. Every investor, every wealth management platform everywhere can add BTC to their portfolio. Pretty damn powerful stuff. And speaking of power, let's talk about the power law model. So the price prediction time. First, from the most zoomed out perspective that is possible, here's the Bitcoin power law model. You see, unlike the stock to flow model, this model doesn't actually rely on a causal relationship between scarcity and price, or really any other factor. It is simply a convenient way to plot the price. It uses logarithmic scales on both the price axis and the time axis. Of course, there are wide levels of uncertainty bands there, but it's the middle green line, the so-called linear regression fit, that represents the fair value of the price. And we are currently pretty damn close to that level. Now, the fair value around the time we may expect this bull market to top out, the fall of 2025, which is the 4-year model, still we can approximately look at, is around $130,000 for one Bitcoin. Will the price go higher? Well, it certainly could. I still think $215,000 is not unreasonable. In all other previous bull market blow-off tops, price has overshot this green line often significantly. Even the relatively tame bull market of 2021, the BTC price topped out at more than double the value of the fair value. Pretty impressive, right? The degree to which the price overshoots the fair value, well, that gets a little bit less each cycle. So let's say it's going to be maybe 50% this time around. Well, that would put us at 130,000 times 1.5, which is roughly $200,000. Let's talk about the Fibonacci levels. See, we can do better than just guessing it will overshoot with a 50% approximate move. Well, let's bring in those old Fibonacci lines. You see, they're like the fingerprints for volatility. You may have heard me and others talk about how we need volatility if we want the gains. I know we all want the upside volatility, not the downside volatility, but it's part of the game. After all, if the price just climbs steadily, there are no lows to buy, right? Anyway, Fibonacci extension levels are a tool that let us predict with some kind of probability, some kind of probability, not perfect, obviously, but how high the price will bounce back from bear market lows. The great thing, the lower the lows, the higher the price will actually be able to bounce up higher. Remember, volatility is good. Keep that in mind during the next brutal bear market, okay? Now, as an example, here's a chart for ETH. So when drawing a retracement for Ethereum from the 2018 top to the 2019 low, the highest fib extension level, the 3.618 line, pointed at a $4,884 Ethereum. That's pretty much exactly what we got, which is crazy, man. Think about that. That's actually nuts. By the way, it's pretty easy to draw these charts yourself on TradingView if you want to ever play around with that. And here's the Bitcoin chart. Now, the first fib levels are drawn for the price drop from roughly 20K to 3K back when the bull market returned in 2020. The 3.618 level for this retracement pointed at a price of 62K, which is indeed roughly where the price topped out. It went a little bit over that by not by a lot, did it? Now, what we're interested in for this video is drawing the fib level from the 2021 peak to the 2022 trough. The fib 3.618 extension brings us to a price of $209,000 for BTC. Pretty interesting. Just a little over 200K. I'd buy it. Maybe 250K, 250 at the absolute top. Anyway, let's talk about liquidity in the banana zone. I started this video mentioning floodgates for the crypto market, right? But without water, a floodgate is pretty useless. So in finance terms, water's liquidity. Some macro analyst's job is to track and predict the so-called global liquidity. Take Julian Battelle, head of research at Global Macro Investor. His work on what he and Raoul Pal have dubbed the everything code. Pretty damn interesting stuff, to be honest. Now, the thesis revolves around basically currency debasement and how this is created by global central bank policies. The core of their thesis is that the central bank 4-year liquidity cycle, aka the money printing cycle, just accidentally walks in tandem with Bitcoin's 4-year cycle. Accidentally, where Satoshi is even more of a genius than we give him credit for. There's also that. Anyway, could even be a main driver for the cycle, okay? Now, Battelle and Powell, they're certainly good with the words here. A term they coined that is caught on is the banana zone. The banana zone. I dig it. Before I'll show you some of those banana zone charts, just a quick shout out to today's sponsor, which is LimeWire. LimeWire is back. So the nostalgic file sharing brand from the early 2000s, they have made a big comeback and a comeback into Web 3. The new LimeWire is now a leading AI studio for creators, and the company has also launched its own token called LMWR, which is already among the top 25 AI coins out there. Now, LimeWire already has over 1.5 million active users. It puts it in a top DApp status. The LimeWire AI Studio allows anyone to create images, music, and video content just by providing access to highly curated AI models. Their native LMWR token, of course, is the native currency for all of that AI content that creators want to get and to pay for their creations and then to earn royalties and rewards for. Now, if you want to try out their product, okay, or you want to learn more about the LMWR token, the project's roadmap, their tokenomics, any of that kind of stuff, you can visit limewire.com, but I'll leave a link down below in the description. We can go over and try out their AI Studio products and have a play around, have some fun, check it out. Link in the description. Okay, now back to it. Here's a chart of the total liquidity index. The line goes up, but in the blue years, the trend reverts. These blue years coincide, of course, with crypto bear markets or crypto winters. The yellow and brown years, they are part of the liquidity cycle where the money printer just goes super extra hard and where asset prices pump right across the board. Okay? Crypto tends to pump the hardest. It is the very high beta move. What they call the banana zone of the cycle is the yellow year, which we are currently in. So here's a chart in which Julian Battelle has overlaid the 2016-2017 crypto spring and crypto summer, aka the banana zone, on the current cycle. Now, on the lower left, this is where we are right now. The current boring crab market is really nothing strange from a historical perspective. And every post-Bitcoin halving market is like this, isn't it? Been around before. This is how it works. We're in the accumulation zone post-halving. Nothing surprising here. The banana zone is supposed to only kick off in late summer or autumn of 2024. Huh? You ready for that? If the 2016-2017 fractal roughly plays out, which of course remains to be seen, right? In this situation, BTC will reach a price around $160,000 in spring 2025, $240,000 in early summer 2025, market peak, bear market afterwards, seller, watch your money disappear. Now, crypto OGs and chart enthusiasts will know that the 2017 bull market took price all the way up to $20,000, which would correspond to almost $1 million in this chart. Now, one can always dream, right? Yeah, right. Anyway, let's talk about the 2013 style double top scenario. So let's go back to 2013. What a year that must have been to carry your bags through. I mean, I know 2020 was pretty crazy too, but this is an interesting year. Look, if you can manage to get through 2013 without losing your mind and your bags, you did well. Anyway, in January 2013, the BTC price hovered around the mark, $13 mark. Okay. It shot up in a straight line, basically, to more than $250 on April 10th of that year, doing more than an 18x in just 3 months. 2013 was built differently. Then it saw a very, very, very volatile, let's call it a reaccumulation range with crashes of more than 50% before once again shooting up for a second super mega rally, pulling yet another 10x or so, topping out close to $1,200. Now, this double bubble of 2013, as it became known, actually created almost a 100x for BTC in a 12-month period. Wow. I was reminded of this chart pattern when I saw this chart sketch by Marty Party. You see, it's just an idea, okay? Just an idea. A fast run up to around 120K coming in the autumn, then a correction / reaccumulation in the spring 2025 before the big blow off top in autumn, topping out around a 250K. And look, this is no prediction, but just one of many scenarios of how this could actually end up playing out. I'd sign up for that. Sounds pretty good to me. But look, there are no guarantees in the markets. Obviously, right? We're just talking about scenarios, things to look for, things that you can help frame your situation and your thinking around. Anyway, again, there's no crystal ball, and there's a gazillion different scenarios we could talk about, and only one of them are going to actually end up playing out. That person can then do a victory lap and say, I was the guy who called it right. But it is remarkable that many of these scenarios drawn from different starting points point to around a 200K-ish area top for BTC in this cycle sometime next year, whether mid or late next year. In fact, I came across a file of a blogger who averaged a few dozen price predictions of renowned chartists. The median top prediction of these analysts, $245,000. Again, no guarantees, but I guess it goes to show that you should be prepared for any scenario. Also, the $200,000 ones. Yeah. All right. Thanks for watching. I'll see you in the next one.